So today we are going to talk about mainly ETF. The title of this talk is The Effortless Investing with Respectable Return. So is it a truth or a myth? Just to introduce myself, because some of you may not know me and it's first time hearing me speak. I'm the founder and CEO of Dr. Wealth, and previously we run a company called Big Fat Purse. All right, so it's still the same team. So I have written books on Secrets of Singapore Trading Guru, as well as the Singapore Permanent Portfolio. So today the topic about ETFs, right, will be more related to the latest book, the Permanent Portfolio. But today we're not going to talk about that topic. Okay, we're going to talk about specifically about ETFs. Okay. So thank you. I just received a notification that our class is full. We have 101 out of 101. Okay, so thank you for your support. And let's begin now. And just to inform you again, we are not trying to do any financial advisory here. It is in the spirit of education, and we believe that you should learn more things in order to make smarter financial decisions in your life. Okay? And today, I believe most of you are working, right? So now, think about this. Do you all prefer to read financial statements or you rather watch Korean drama? If we do not have this webinar on, right, which one would you prefer to do so? I would suppose that most people would rather watch Korean drama than to go and read all these jargons, right? Imagine you have worked the whole day, you have made so much decision, you're so drained, and go home, you're still going to use your brain. It's going to be very tiring for you. So that is why I realized, right, even my friends, most of them, they will always rely on a financial advisor to make their investment decision, their financial decisions in their life. Okay, there's nothing wrong about it. Okay, but do you know how well are they doing in terms of managing your money? Are they doing above your expectation or below your expectation, or do you even have an expectation in the first place? Okay, so we'll go through a little bit about this and let you understand what are the problems that you may face engaging financial advisors. So here's the hard truth that I want to tell you. As we established, most financial advisors, most people rely on them because it is very tiring to make financial decisions on your own. Okay, there's nothing wrong about it. Something about this that many people do not know. In 2011, the Monetary Authority of Singapore has done a mystery shopping. So what they did was some of the officials disguised as consumers visited banks, visited advisory firms, meet up people, and then test whether processes were made and whether recommendation of financial products were suitable. So the finding was very interesting in the sense that I was appalled that one out of every 3 policies, right, was clearly missold to a consumer. So which means every one of us have a 33.3% chance of being missold of a financial product that we don't even need in the first place. So that is a very, very high chance of spending money in areas that we should not be spending at all. Okay, so and we all know, that a lot of these advisory, because they depend on commission, they tend to be sales driven. That means if I'm a financial advisor, I may be inclined to sell you something that makes me money and not whether you need it or not. Okay, so how do you know whether a product is missold or not? You need to have some financial understanding, some financial literacy going forward. Else, you always fall prey to all this sales-driven advisory. Okay, so we always see ads like this, right, where our dear insurance companies will always be part of our lives, saying that they will walk with us every step of the way. Okay, nothing wrong about that, but something that was very striking was that once I visited one of the insurance company in Singapore to see my friends, and then at the lobby of the big institution, I saw a board. The board was saying how much sales they have done that year and how much target they were trying to achieve. So the whole lobby was also plastered with top agents, pictures of this month, of this year, etc., etc. So it dawned to me, right, that even though in the ads they say that they really care about us, right, but I think they care more about the sales target. We are more like numbers to them than real people. Okay, so this is what actually it means. And imagine you're pressure cooked in an environment that always throw sales target at you, how can you not be sales driven in your advice, right? So the environment, in my sense, does not do any good to advisors who really want to help people. So I think it has come to a point where we have to really take care of our own finances, all right? And even if you engage a financial advisor, you need to know what you really need at the end of the day, okay? Right? So let's go on to the next slide. And I also know a financial advisor who eventually one day wrote an ebook about this investment linked policy. Okay, he actually said that all these ILPs, in short, right, investment linked policies, are ticking time bombs. Okay, why a financial advisor would want to destroy his own rice bowl? Okay, this is something that he really believed in. And then he explained in the ebook that he says that a lot of these ILP become very expensive in the future because there's rising insurance costs, and when there's not enough money to pay the premiums, they actually sell off some of your unit trust, which is your investment, to pay for all these premiums, to subsidize for all these premiums. So at the end of the day, right, your returns is sacrificed for insurance costs, and end up it doesn't bode well for you. So it is better to treat insurance and investment separately, if you ask me. Okay, everybody still require some form of insurance, all right, but I don't think it's a good idea to mix them together. So you need to say no to financial products you don't need, and your best defense is financial literacy. So thank God you're here today. So 101 of you, and today we are trying to raise your financial literacy. Okay. And you need to break conventional thought. And in what sense I say conventional thought is because a lot of people, they invest in probably ILPs or unit trust, okay? And very seldom people know about this thing called ETF. And I just want to let people know that it is a very viable investment option. Even for the layman, you don't need to have very in-depth financial knowledge in order to use them properly, okay? So what is an exchange traded fund? In short, that was what ETF meant for, exchange traded fund. Okay, so let's break down the term. Exchange traded, it actually means that listed on the stock exchange. And so you can buy this instrument like you buy and sell normal stocks. Okay, so it's very simple. That's why it's called exchange traded. And what is a fund? A fund is basically a basket of securities that is managed by a fund manager. Okay, so when you buy a unit trust, it's also a fund, and there's a fund manager who decides what are the stocks and what are the bonds to be inside this fund. Okay, so there is a decision maker in that sense. So ETF, in short, is a fund that is traded on the exchange, and it buy and sell like normal stocks. All right, and there are a few important terms that I need to explain to you. Things like index. Okay, so what is an index? You often hear that during the news, right, every day they will say, during the business segment of the news, they will say something like this: oh, the Singapore stock market went up today by 1%, etc. All right, what does that even mean? So they actually base off something called an index. So for example, let's explain first, right? A stock index is a theoretical value of a basket of stocks to represent a particular segment in the stock market. So for example, the Straits Time Index is what the broadcasters locally use to describe whether the Singapore stock market goes up or down. All right, so it's STI in short, Straits Times Index. And almost every country have this their own country index, and there are a lot of indices in the world that more than you know and I know. Okay, it's almost impossible to track. I think there are thousands and thousands of indices around the world, not just in stocks. It can be bonds, it can be in commodities, etc., etc. So a Straits Times Index is nothing complicated. So it's made out of 30 stocks, and all these stocks are probably very well known, right? They are your blue chip companies. A lot of them are Temasek linked companies, and these are the bluest of the bluest. Okay, so these 30 stocks make up the STI index, and because they represent almost 70% of the total Singapore stock market, right? That's why the movement of these 30 stocks is good enough to represent the entire stock market of Singapore. The question is, how is the STI constructed? Who determines whether these 30 stocks are there, right? So it's determined by these three companies jointly, SPH, Singapore Press Holdings, SGX Singapore Stock Exchange, and FTSE Russell, which is a UK indexing company, which is internationally known. And actually, why is it called Straits Times Index, right? A little bit history, right? So it started in, if I'm not wrong, 1966, and it was Straits Times that publishes this index. In those days, that's why it was called Straits Times Index, like it's our national paper, right? The Straits Times. So that's how it got its name. So over the years, that's where they got more professional indexing companies like FTSE to take part in the methodology in calculating these indices. So these three companies, do they just look at the 700 to 800 stocks in Singapore and say, oh, I like this stock, I put inside, I like this stock, let's vote. All right, it is not that case. How they do it is actually by pure mathematics. All right, and let me show you the formula. Ta-da! This is the formula. Okay, so you don't need to care about how this is derived. Okay, the exact formula. I just want to show you that there is a formula, and most importantly, you just need to know the index was constructed based on pure mathematics. All right, pure mathematics. There wasn't any qualitative assessment or anything. It is just pure math. And the concept is that it is market weighted. That means the bigger the stock, the more float that it has in the stock market, right? That means more shares traded in the stock market, right? Value, okay? In terms of value, they get a bigger weightage in the index. Okay, and you can see most of the bigger companies that's in the index are your telcos and your banks, okay, because they are the more influential, more heavier stocks that is representing the index. So it's pure math. Every day they will calculate this value and it determines the STI value for the day, okay. And the latest change, so it is not always the same, 30 stocks, it will change. And the latest change was done last quarter in March. So Noble, because of all the alleged fraud, right, about their investments in Australia, etc., and their accounting practices, so their share price have dropped a lot, and which means their market weight has also dropped because market weight is dependent on the share price as well. So Noble Group has fell out of the index and Capital Land Commercial Trust has been added in. So there is a reserve list that the three companies, SPH, SGX and FTSE, curate, and they will tap on this reserve list whenever required. So they meet every 3 months to reconstruct the STI again. So there may be changes. So far, actually, for the past few years, there have been changes every year. Okay, so the latest one was Noble Group was replaced by Capital Land Commercial Trust. So another important term is called passive. Okay, what does that passive mean? When you look at ETF, right? So terms like index, passive, these are very, very common terms. Okay, so what does this actually mean, right? What is passive? Okay, so let me explain to you. Oops, sorry. Okay, here we are. Okay, so you are just one of the investor here. Okay, you're just one investor. So you put money, right? So you invest your money inside a trust. Okay, so a fund manager do not mix your money with their own money. Okay, so this is called a segregated account. This is what is required based on the MAS regulation. So your money is handled by a trust. It can usually be a bank. Okay, it's a bank. All right, so the fund manager will instruct the bank what to buy and what to sell, and then the trust will hold onto the stocks and bonds on behalf of the investors. Okay, so that's how the structure is worked out. And the fund managers, right, what does it mean by passive, right, is that the fund manager doesn't make any decision. Okay, the fund manager, the keyword is blindly follow. Okay, if blindly follow the index. So for example, if they follow the STI, they will have to buy the 30 stocks, all right, in the STI. Okay, and they cannot deviate. Even the exact weightage, right, they'll always try to mirror what the STI weightage is. Okay, so the keyword is blindly follow. So that gives you the meaning behind it. So it's passive. So there is no active management. The fund manager doesn't make any decision on behalf of the investor. They simply follow the index. All right, so it's passively managed. Okay, and you actually would know that ETFs, right? Later we'll go to another slide. I'll show you why ETF is very low cost. But to explain to you first why they can afford to charge lower fees. Okay. because active management, right, needs to hire more analysts. Think about this. If every stock you need to analyze, you need a lot more headcounts, right? You need to hire more people to pour through reports, to visit companies, to talk to management, to punch calculation, to do projections, etc., etc. So you need a lot more headcount. So imagine your passively managed fund, right? You just follow the index, right? How many headcounts will you need? Probably you don't even need an analyst, right? Because everybody knows what the methodology is. Everybody know what the index weightage is because it's all published openly. So you can just instruct the trust to say, hey, I want to buy this set. Just rebalance for me for the portfolio. So they don't need so many headcounts. All right. And then secondly, right, in terms of distribution, unit trusts need a big sales team. They need to feed every single advisor's financial consultants because they are the ones that are running around the streets to sell these unit trusts to people. So they need this, and all these agents cannot do things for free, right? They also have their own family to feed. So they need a salary, and they need a decent salary in order to keep them doing this job, else they will leave as well. So they will need to feed a big sales team. But let's for ETF is a different case because you don't need agents to sell. It's distributed through the stock exchange. So which means everybody who has access through a brokerage platform, you can buy or sell ETFs easily. Okay, so that is why ETFs operate in a much leaner organization structure, and they are able to pass on all these cost savings to consumers and investors. So that is the advantage that active funds do not have. And this is the cost, how it looks like. And when you look at the breakdown of the unit trust cost, it's actually quite alarming, in my opinion. When you buy a unit trust from your agent or from your banker, the sales charge can be as high as 5%. Think about this. A typical stock index average about close to 6 to 8% per year. And imagine that here you have to pay 5% sales charge. You're already down 5%. That year of returns can be wiped out easily. And that is a one-time charge. And thereafter, every year, you have a management fee, which the fund manager need to be paid, right, to do the work. It will cost about 1.5% of what you have invested, okay, your value, fund value. So which means even if your investment did grew, you will pay a higher fee because the absolute amount has increased, even though it's based off a 1.5% fixed fee. And the trustee will also need another 0.1% because segregated account, right? So the trustee also hold some assets, they'll tap on the cost as well. And depending on what kind of a platform you use to buy unit trust, some people actually charge you 1% when you switch one fund to another fund. And that may also be a back-end fee known as a redemption fee. That means that is when you sell a unit trust, it can also charge you a sales charge up to 5%. So you can actually extract a total fee of 11.6% when you buy a unit trust. So that is essentially a good 1 whole year or 2 years of returns wiped out totally. And all this money just go to the the financial industry revenue. All right. Take a look at the ETF. The sales charge is very low, 0.28%. This is a typical brokerage charge that people pay when you buy and sell stocks. Okay, so it's the same charge. So 0.28%, minimum $25. Management fee is usually less than 1% for ETFs. Trustee fee is the same. ETFs also you have to use a trustee. And switching fee, you just take it as you sell the unit trust to buy another one. So that's you sell an ETF and buy another ETF. So you will also incur a brokerage fee of 0.28%. Redemption fee, selling fee is also 0.28%. So all in all, the total fee can be up to 1.66%. So you compare the unit trust total fee to the ETF total fee, right? You can see one is almost 10 times, slightly less than 10 times. So probably about 8 times more. And all these costs, if you understand the compounding effect, right, costs can also compound against you, not just returns, okay? So it is important to look at this aspect of things. And unit trusts not just have this problem, not just that they are more expensive. If they are more expensive but they deliver good returns, right, it's fair, right? I mean, at the end of the day, it's fair because you're paying for performance. But let's look at their performance. How are they doing actually? So I actually compiled based on 31st May 2016, right, the returns of actively managed Singapore stock funds, Singapore equity funds versus the STI-ETF. Okay, so again, an STI ETF is the Straits Times Index Exchange Traded Fund. Okay, so it tracks the STI index. And you compare this, right? You might see that, oh, STI ETF is number 4, not very high up in the charts. Okay, out of these 10 funds that we're looking at. But bear in mind, these returns of the other funds are before fees. So you haven't taken the sales charge, you haven't taken the management fee. So this is a pure returns only to be apple-to-apple comparison. So let's just look at this, okay? But you can also say that STI ETF beat most of the funds. Can I say that, right? Because it's above that top 50%, right? And take a look, if the rest are actually charging you more money but performing worse, okay, shouldn't you stop investing in all these funds, right? So that is why I think that unit trusts have lost a lot of their selling points when all these ETFs have been introduced into the market. So I think this is time where more people have to understand the availability and the power of ETF, how it can really maximize your returns as a retail investor. Okay. And globally, right, not just in Singapore, globally, the performance competition, right, is even worse. So there is a journalist in the New York Times, right, wrote about this. So he studied the US funds, okay, 2,862 of them, all right, from 2010. Then they see how many of these funds actually beat the index. So in 2011, right, of course, some of the funds will be kicked out, okay, because they didn't beat the index. Then as time goes by, less and less funds remain. And the most startling point is that within 5 years, there were only 2 left out of 2,862 funds, okay, left that beat the index consistently over a period of 5 years. So imagine this, when you start 5 years ago, right, I show you these 2,862 funds. Can you identify these 2 funds that will beat the index? So the chances is very low because actually, if you flip the coin, you have a higher chance of making money in the stock market, whether to buy or sell, because it's 50%, right? So this is, by the time you end up with only 2 funds, right, the odds is much less than 50% chance, okay? So this is why we think that the odds is really against actively managed funds from since a long time ago after ETF has been introduced. And S&P 500, S&P, right, the Standard & Poor company, actually have this SPDR, stand for S&P Standard & Poor Index versus Active. Okay, so every year, right, S&P will draw all the results, all the returns from actively managed fund versus the index and see how many percentage of this actively managed fund didn't beat the index. Okay, so all in all, you can see right here, I just want to ask you to focus on the 10-year. Let's look at the longer term, right? So 80% of the actively managed fund didn't beat the index, okay? So S&P 400 versus mid-cap, right? So these are the middle weighted companies, okay? Not very large, okay? Not very small. 87%, all right, didn't beat. And then the last one, the small cap as well, most of them are not able to beat. So again and again, you see majority of the actively managed fund are unable to beat the index. Okay, so all these statistics keep showing you that it is stacked against you. The odds is stacked against you when you buy unit trusts or actively managed funds. So if ETF is so good, right, why advisors don't promote them? That's the important question to ask, right? Why our local advisors don't promote them? Okay, so you can see I put the picture there, right? So it means that there's not much money to be earned. Remember, there are not much fees that they charge, which means they don't put money into the pockets of advisors. So that's one of the reasons why advisors don't promote ETF. Okay, advisors can talk about ETF, but actually there's another problem, right? It's the way that our financial industry is structured, okay, based on the financial regulations, right? There's 2 main licenses when we talk about financial industry in Singapore. There's a Financial Advisors Act, which governs the financial advisors, all right, and they can execute unit trust transactions on behalf of clients, okay? And then there's another set of license called the Securities and Futures Act, which governs ETFs and stock brokerage in general. And your ETFs can be bought and sold by via a stockbroker. Okay, so which means a financial advisor would not be able to transact an ETF for you. So they can advise you which ETF to buy, but they cannot transact for you. So what is good with that, right? So it's a very stovepipe kind of a regulation. And I think that eventually MES will have to find some overlaps and try to see whether they can make the regulation more robust, right? Because think about this, right? As a consumer, it doesn't help me at all. That means I need two different people to serve my financial needs. And then if one person A say this and person B say another thing, so who should I listen to, right? So there is a very poor consumer experience in terms of that. And that is why I think financial planning should be holistic, and the regulation should facilitate this kind of consumer experience and not be very complicated, very stovepipe in the way that we do things. All right. So, but things are changing, and recently, just this year, 2 months ago, MES has eased rule on ETF transaction. So 20 financial advisory firm has actually applied permission to transact ETF for clients, and this has been approved. So this is a good thing, and the Financial Advisory Act has expanded a little bit. So now the modality is able to for financial advisors to do execution of ETF. So do ask your financial advisor about this, whether they can do it for you. All right, don't just let them keep selling you unit trust, and unit trust. Ask them for this option. Do they trade? Do they offer exchange traded funds? And I can tell you, usually the good ones are the ones that have this option, and the sales driven kind of companies will not have this option. All right, so it's a very good way to test. So now we have to look at what are the important things when you try to identify ETF. Okay, there are a few things, and I just want to touch on the four most important ones. Of course, the number one thing is called the total expense ratio. So this is the cost of the ETF, and you want it to be as low as possible. Okay, the lower the better. Then you can save a lot more money and put more money into the market. Second, you have to understand whether the ETF, right, is it a cash-based or a synthetic ETF? Okay, what does it mean, right? So a cash-based ETF means when the fund manager get your money, all right, they actually use this money to buy the underlying stocks or underlying bonds. Okay, when it is a synthetic, right, it doesn't buy the actual stocks, actual bonds. What they do is they actually buy derivatives, contracts like futures, options, etc., etc. So just to replicate the index via all these derivatives. So in that sense, if you ask me, it's a lot more complex, and you shouldn't go into it. And it's always better to buy the actual stuff, and the fund managers actually hold the underlying assets. All right. So this is a very important thing that you need to know. Later, I'll show you how to look out for all these things. All right. So don't worry. I'll go through two more points first. And third thing is you must know what is the underlying index. So when we say STI-ETF, right, so the underlying index will be STI, right, Straits Index. And then you know that, oh, you're investing in Singapore stock market. Okay, so you need to know what you are investing in, and you should even know what you want, right? You want to invest in Brazil, you want to invest in Russia, you want to invest in China. Are you investing in the stock market, or are you investing in the bond market? All this you must at least have a rough idea where you want your money to be exposed to, which region, what kind of asset class. Okay, so the underlying index is important. And lastly, you need to know what is the fund company that's managing this ETF. Okay, so for an index ETF, right, let's say a STI ETF, there are already two, right? Two different fund companies offering STI ETF. So which one should you go for? So these are some of the things that, these 4 points are some of the things that you need to know to identify an ETF that's suitable for you. So let's just run through some examples, all right? And there are actually 60 over ETF listed on the SGX, Singapore Stock Exchange. The number has grown over the years, right? Okay, so I see some question, right? Keep them coming. Later we'll address it at the end of the session, okay? So just bear with me. I'll just run through the content first. So ETFs listed on the SGX, there are many, and you can see the counter name is not so easy to understand, okay? But that's why I'm here to explain it to you, all right? That is part of the financial education. So let's head on to the SGX website. Let's go to SGX website. Okay, here we are. All right, so you can mouse over the market information. All right, let me just enlarge a little bit so that you guys can see. Okay, so you can mouse over the market information and you can click on ETFs. Okay, so the page on ETFs will be here. Oh, so I'm wrong. There are 86, not 60 over. There are 86 ETF available on SGX. So the number is increasing. So that's a good sign because that means there are more options for retail investor. And let me just enlarge even further. All right, because the first two columns are the more important one. So the counter name, right, tells you a few information about the ETF, okay? So let's say DBXT, right? You can see this DBXT, right? This is the fund manager, all right? So this is a shortcut. DB, if you see DB is Deutsche Bank, which is the German bank, okay? And XT is just their series of ETF that they want to name it. And this shortcut, right, MS, USA, what does it mean, right? It actually means MSCI, Morgan Stanley Composite Index in the US, okay? And this US dollar, it means that this ETF is denominated in US dollar, okay? And if you want to know more, right, if you don't understand all this jargon, all this short form, right, okay, you can click the code, okay? It will bring you to the page with more details and you will be able to, let me just make it smaller again, right? Okay, so you'll be able to find more things like there are prospectus for you to download here. When was it listed? Here's the full name and MSCI USA. See, I also don't know what is this TR. Total return. Okay, total return index. Total return net index. Okay, so usually if you don't understand what it means, right? Okay. Oh, my audio got cut off. I saw a page. I saw a question. Can you all hear me? Oh, back on. Okay, can. Sorry, you got cut off for a while. All right. Yeah, just keep the question coming. I'll address them later. So no problem. All right. So this is the details, and you can go to the website of DB, the DB website for the ETF to know more, their fact sheet, etc., etc. But very simple. One word advice. If you don't understand the name, right, don't touch it. Okay, means you don't know what it is, it's better not to buy anyway, right? Okay, so there are some more common ones that is easier to understand. So let's go through some of them. Let's look at probably the STI first. Okay, if you scroll down, right, you can see this STI-ETF. Okay, so this is the Straits Time Index ETF that represent the 30 stocks. Okay, so and this is the code ES3. So let's take a look when we zoom in, what does it mean, right? And let's try to go to the website of this ETF. This is by, you can see this is by SPDR. So this is by Standard & Poor, right? Okay, so let's just go to do a search SPDR, STI ETF. I just want to show you the 4 factors, right? Remember the 4 things that we need to find out. What is the cost? What is the underlying index? Who is the fund manager? And what's the one more thing that we said? Cash or synthetic, okay? Cash or synthetic, actually just now we can see already. Later I'll go back again. So this is the site. So make sure the name is correct. SPDR Straits Times Index ETF, all right? So here you can see the returns, okay? But remember what we are specifically looking for? Total expense ratio. So 0.3%. Okay, so it's reasonable. ETF should be below 1%. All right. So if anything is above 1%, it is too expensive. And in fact, actually, if you ask me, anything above 0.5% is expensive for ETF. So it should be below 0.3%. Something about this expense ratio, right? So it does have economies of scale. The bigger the ETF, the lower the fee they can go. All right. So there is a popularity effect. Economies of scale. So that's why if you go for the larger ETF are better, the more well-known ones are better because your costs are also cheaper. Okay, so that's number 1. Number 2, is this cash or synthetic? How do you know whether is it cash or synthetic? So let's go back to the list. There's something important that you need to learn how to read it. here. Okay. So beside the counter name, right, can you see this column called the SIP? Okay, this SIP, right, was actually introduced by MAS, Monetary Authority of Singapore, to protect retail investor. That means there are some ETF, right, if they are under SIP, right, you need to take tests before you can buy the ETF. Okay, you need to pass a test before you can buy the ETF. So if you see this kind of symbol, if X and alias, right, actually it is the alias. If you see alias, means you must take test one. So you cannot just anyhow buy. You must pass the test, then you can buy the ETF. So what is this X mean? This X means this is a synthetic ETF. This is not cash. Okay, so X and alias means it is a synthetic ETF and you need to take tests. Okay, so MAS is trying to tell you and label this that you better don't touch. Okay, so it is true, you better don't touch. All right, so you can take a look. So all these X alias, right, you can just skip them. Okay, you can just skip them because they are all synthetic ETFs. All right, so they are not the real stuff. So you can see out of 86, actually a lot of them are synthetic. Okay, so it is better to stay away from them. All right, so not all ETFs are created equal. All right, so avoid them. So that's your point number 2. Point number 3 is that we want to know what is the underlying index, right? So let's go back to this. This one, without a doubt, we know the underlying index is actually Straits times index. Okay, Straits times index. They also tell you the fund objective here, right? They want to generate returns closely correspond to the performance of the Straits times index. So now you know, if you buy this, your performance should replicate close to what the index returns is. Okay, can So the last question is, the last point is you need to know who is the fund manager. So here, who is the fund manager actually? A lot of people will think that the fund manager is SPDR. Actually, the fund manager is not SPDR. The fund manager is State Street Global Advisor, okay, which is a subsidiary of SPDR. All right, but it is not actually SPDR. In US, SPDR is a very big indexing company. In fact, they even have a name for themselves, right? They call them the spider ETF, right? Because the spelling looks like it's like a spider, right? Only lost an eye there. Okay, so SPDR is definitely a very big company, a very well-known company in the US and actually globally. So which means this fund manager is quite reputable, even though let's say he's not, but State Street Global as a subsidiary would have some of the oversight and influence from SPDR. So you can tell from here that you can assess that, okay, this fund manager is someone who I can trust. And especially if you look at another thing, right, the track record. Okay, so they've been around since 2002 and now it's 2016, so they're around for 14 years. So on this track record, right, the longer the existence of a fund, the better it is. So anything that have existed more than 10 years, it is actually quite stable in my opinion. They won't just disappear overnight, etc., etc. Okay, Ken? So these are the 4 points that you need to at least establish before you want to consider buying an ETF. Okay? Any question you can direct to me, then we can always discuss later. Alright, so the expense ratio I explained already, 0.3%. Okay, so these are the 4 points. Just remember these are the 4 points you need to look out for in an ETF. And this is a summary of ETFs that are not SIP, okay, which means they're EIP, excluded investment products. So that means you don't need to take tests, you can buy this. And the good news is STI-ETF is one of them. And Nikko AM STI ETF, you can see here, right? Nikko AM STI ETF is also exempted. All right. So you can see STI ETF just now was managed by State Street Global, right? And this STI ETF is managed by Nikko Asset Management, Nikko AM. Sounds Japanese, okay, but it's actually owned by DBS. DBS bought over this management. So this is by DBS and this is by State Street Global. And you can see there are others over here. I'll just go through, I separate them into geography, okay, which country and which region they are, and by stocks, bonds, and commodities. Actually, the commodities, there's only one that's, you don't need to take that one, that's the gold ETF. So if you don't want to buy physical gold, this is another option that you can get exposure to gold. Bonds, you have all this, okay, mostly in Asia. And there's one in Singapore, right? This is they mainly buy Singapore government bonds, stat board bonds like HDB, LTA. They do issue bonds to raise money, and they are also US. So the last one, this is the inflation-linked bonds, treasuries as well. All right. If you ask me, actually most of the time, bonds do offer a lot more access to certain organization as compared to stocks. Okay, why I say that, right? Because there are certain bonds, right? They are only available for institution. So retail investors, you can't even touch it. And some corporate bonds are only available at very big tranches of $250,000. So which means, right? Usually, if you want to get a more diversified bond exposure, you have to use a fund. Okay, that is without a doubt. For retail investors, I mean, if you are high net worth, you still can get access. But for retail investors, you have to get diversification of bonds via funds, either ETFs or bond funds. So there are a lot more value when it comes to funds. All right. But for stocks, because you can buy stocks in just one lot, right? So which means you don't have the minimum size issue. All right. And just want to run through some of the fund managers that are running some of these ETFs in SGX. So CIMB is the Malaysian bank, right? So DB, I told you already, this is Deutsche Bank. And IS, right, stands for iShares. Okay, so this is by the BlackRock, which is also owned by Barclays, right? So the more internationally known fund index ETFs, right, are your SPDR, your iShares people. Okay, so these two are the very big players when it comes to ETFs. So they are generally much more prominent managers as compared to the rest. Okay, so you can also read more about ETF via this URL. Actually, how you find this, right? Let me just show you here. You can go back to SGX, right? Okay, you instead of market information, you go to products and you click on ETFs. Okay, so all this information about ETFs to explain to you. You can even download investor guide, full list of SGX ETFs. Okay, so you can get this document for free, so you can look through who is the fund manager. You can see from here clearly what is the underlying index. All right, so use these resources to help you find the answers to the 4 points that I mentioned. All right, so let's compare the two STI ETF, because as Singaporean, so it's always good to start off from Singapore first. Okay, so STI ETF, sadly, a lot of people, even though it has been around for so long, a lot of people still don't know them. So I need to do some marketing for them, because your financial advisor is not going to market for you, market for them. So I have to market for these two products. Not that I want to give you advice, but I need to give you more awareness about them. All right. So I mentioned one is by State Street Global, one is by Nikko AM. So State Street Global ones have been around for 14 years. Nikko AM has been around for 7 years. So don't compare the returns because they are different periods. So, but we can compare the 5-year returns. You can see they are very close together. Okay. So that in performance-wise, right, there's not much difference. But you can see the expense ratio. There's a bit of difference. So given a choice, if the return is about the same, and in fact State Street is a bit longer and cheaper, it makes more sense to go with the SPDR, State Street Global STI-ETF. Okay, and the dividend yield use about 3.5% per year. Very, very decent, right? Well diversified, blue chip, and get 3.5%, even higher than your CPF ordinary account, right? Just by dividend alone. And your Nikko AM, they didn't put a dividend yield, but I suppose given that their returns are about the same, the dividend yield will also be about the same. Okay. Actually, I just saw one question that I can quickly answer, and it is relevant to what we're talking about. So you talk about liquidity, right? Okay, liquidity, right? So you're afraid that liquidity means whether there are enough people buying and selling, okay, of the ETF. All right. So let's take a look at the ETF again. You notice, right, some of the ETF, there's not even a single trade the whole day. You see, the volume was 0 for the whole day. Okay, so you might worry, right? If I buy, right, would I be able to sell them? Okay, or if I buy, would I be able to get the price that I want? So you have to you realize, right, that there's this buy volume and sell volume numbers here. Okay, so it actually tell you that all the ETFs listed on SGX have a market maker. Okay, even you go and download the ETF fund fact sheet, right? You can see there is a market maker. Right? They are market makers for all these ETF. What does it mean is that as long as your price is right, within the range, right, buy and sell range, right, you know, when you go and exchange money, you got to buy bid and ask spread, right? So as long as you offer a price between this spread, right, and based on the market maker's calculation is a fair price, right, they will deal with you. Okay, they will deal with you. So you don't need to buy another, you don't need to sell to another retail investor, or you don't need to buy from another retail investor. The banks who are the market makers will actually trade with you. Okay, so these are known as open uh, uh, not open-ended funds. Okay, open-ended funds. All right, that means they are market makers for all this kind of activity. So they were able to control the ETF price close to the fund NAV. Okay, it's a very important characteristics. All right, so to keep the price fair, so you don't get very overvalued valuation of fund or very undervalued valuation of fund. So they are able to create and destroy units to control the ETF price. Okay, so don't worry about liquidity. They are all market makers. Another good thing, STI-ETF is a CPFIS approved ETF. That means you can use your ordinary account to invest in the ETF. Actually, in the CPF SA, which is your special account, they did say it is possible to invest in ETF. It is approved, okay? But when you read further, there is no ETF that is listed on under the CPF SA. Although they say you can invest in ETF using your SA account, but there is no ETF that you can invest in SA account. So it's a bit confusing. So right now, you can only use your ordinary account to invest in ETF, like how you invest in unit trust as well. Okay. Another question that I always get is that, is it better to invest lump sum? That means put in the money one time instead of breaking it down into like monthly smaller amounts. Okay, that is known as dollar cost averaging, right? I believe your financial advisor always tell you this. Dollar cost averaging is a better method because every month, right, you just, let's say, put $100 into the market, right? If it becomes cheaper, you buy more, correct? So let's say share the STI ETF was worth $1. If you $100, you can only buy 100 unit. But if the ETF, right, price drop into 50 cents, with $100 you can buy 200 units. So it become more and more and more. So dollar cost averaging sounds very, very logical, correct? But actually research has shown lump sum investment will have a higher chance of higher return than dollar cost averaging. Why? It's very simple concept actually, okay? Think about this, right? Actually the lump sum scenario is good, right? If let's say you buy here, okay, you buy one lump sum and the market continue to go up, right? And then you sell, right? It makes you much more money, okay? Imagine you didn't buy one time, okay? You buy the first time, okay? Then you buy a second time, and then you buy a third time. Is it going to be more and more expensive? Yes, okay? So that means you buy less and less unit, all right? So which means DCA doesn't work well when the market is trending up, okay? Because you buy more and more expensive. But DCA is very useful when the market goes down. Okay, because you don't want a scenario where you lump sum, you buy everything, then it go down all the way, you lose a lot of money. Okay, but imagine if you buy slowly, you buy one time, you buy second time, etc., etc., you buy cheaper and cheaper. Okay, so it become cheaper here. Okay, it becomes cheaper. So when it becomes cheaper, it is better to use DCA. Okay. But the question is, how do you know whether the market is going up or down? Correct or not? So it's almost impossible to know beforehand. So if you ask me, don't think about timing the market. Think about your situation. If you have capital now, do lump sum. Okay? If you don't have capital now, but you have a job, you have a career, you have a money income, set aside money fee, money amount to invest using a DCA method. It is fine. Okay, so it should be from your capital consideration, the availability of capital, and not whether you think the market is going up or down. All right, can And this is just a personal experience I want to show you. So I did a DCA when I just before I started working, and it was during the peak when I started. I put in $200 a month. in 2007. If you remember, it was a super bull run, right? So actually, should I do DCA when the market is rising? Actually, no, right? But I didn't consider that because I just wanted to set aside some monthly salary to the stock market. So I want to invest while I save. So that's all about the simple idea. And then 2008, the financial crisis came and the stock market crashed 50 to 60%. And I got a pay raise in 2009. So I doubled the monthly contribution to $400. So actually my timing was bad. I should have increased it 1 year earlier, right? Then I can average down a lot more. Okay, so even though my timing was not immaculate, right, I was able to get a 17.5% gain over the crash period. So I still make money even though the stock market crashed because I was able to dollar cost average down during the period. Okay, so DCA has its place, is good for this scenario, but I said you cannot predict this. So it's in terms of your capital availability consideration before you make a decision whether you should go lump sum or DCA. All right, so it's just a personal experience I wanted to share with you. And someone asked about the POSB STI ETF plan, right? So now I can answer you. That's the reason why I don't want to answer all the questions throughout the presentation, because some of the things I will cover later. So this POSB STI ETF plan is something that I cover now. So there are 4 companies that offer this DCA or monthly investment plan. There's POEMS, there's OCBC, there's POSB, and there's Maybank Kim Eng. So when I started, there was only POEMS. They were the only one with this money investment plan. None of the other companies have. Then I think OCBC introduced, then POSB, then Maybank Kim Eng in this sequence. All right. So let's take a look at their comparison here. Okay. So all of them, their minimum investment is $100. Okay, $100, no difference, huh? And the fees are very different. Okay, so for Philip, if you let's say invest in STI ETF, one counter, let's consider as one counter, minimally $6. Okay, that means if you only invest $100 and the fee is $6, your fee in percentage term is 6%. Wow, very high, almost like buying unit trust already. Okay, so it's not worth it. Then look at OCBC, 0.3%. Okay, sounds about right. But then minimally $5 per counter. So which means if you only invest $100, you will not be charged at 0.3%. You'll be charged at $5. So which means also very high, 5% cost. So also not good. Then POSB, $100, 1%. Okay, can. Then after that, you see Maybank Kim Eng, less than $1,000, 1%. Okay, so POSB and Maybank Kim Eng seems to be cheaper, right, in terms of the fees. And let's look at the dividend reinvestment. Okay, whether the company help you reinvest the dividend, because you know that if they reinvest, right, your money will compound faster. So Philip, right, or Poems is the only company that gives you the auto reinvestment. Okay, they do it automatically for you. There's a 1% charge on your dividends. That's what they do. But I mean, for this auto investment, it's very good tool, because the reason why you want to start this money investment plan, right, is that you don't want to spend too much time on it. Okay, and you don't want to, every time the dividend come to you, you have to go and manually put it back into the stock market again. So it's very troublesome. You may miss it sometimes. And STI ETF give you 2 times dividends a year. So you're going to do at least 2 times a year and transfer their money. All right. So otherwise you will compound at a slow rate. So Philip does it for you automatically. So that's their advantage. OCBC, POSB, Maybank Kim Eng, they directly credit it to your bank account. Okay. So Poems is the one with this advantage. And when it comes to selling, right, look at the charges as well. Philip and Maybank Kim Eng, because they are your brokerage firms, they will charge normal brokerage fee, right? But actually, if I'm not wrong, you have to call in to sell. You cannot trade over the internet. So which means you have incur 2 times the price. So instead of $25, is $50 minimum. But I mean, when you sell, it should be a large amount, and it is the fee is still low compared to if you have done do it via the unit trust rate. The best will be POSB. There's no sales charge at all. Okay, so to help you decide, right, if you ask me, if I were you, if I'm going to invest less than $600 a month, less than $600 a month, I will go with POSB, right? Because the upfront fee is the lowest, and the selling fee is the lowest. Alright? If I'm going to invest more than $600 a month, I will go with poems, okay, because of the auto reinvestment and the cost, because as you increase your investment capital, you'll be close to what the POSB charges will be like. Okay, so below 600, I'll go with POSB. Above 600, I'll go with poems. All right. And I just want to probably give you some of the risks. Even ETF also have risks. So I just take STI ETF as an example. You know that STI only invests in Singapore stocks, right? The top 30 stocks, right? So which means it's very geographically focused. So anything that happens to Singapore, your STI ETF, your investment will be heavily affected. Okay. And secondly, there's also institutional risk, okay, because you're using a fund manager to manage for you. There are risks like what if the fund manager is a fraud, or what if the trustee is a fraud? Your money can be gone. Okay, very low probability, but not totally impossible. Okay, so these are some of the risks that you need to know. So all investment come with risk, and that's how you manage it. And usually people don't just buy, let's say, STI ETF, right? So some people will buy, you buy S&P 500, get some exposure to US, and you may buy some bonds ETF as well. Okay, so usually people will have a portfolio and they structure it differently, and that's how you spread your risk out. Okay, using different fund managers, using different trustees, using different geographical area, using different asset classes. So let me, before I carry on, right, let me just answer some of your questions. Okay, answer some of your questions. Let me look through what you have posted just now. Okay, so Nicholas was asking how you explain how to judge the liquidity of the ETF. So I mentioned already, you look at the trading volume. If there's very thinly traded units, right, per day, right, you can tell there's very low liquidity. But I told you it's not a worry because they are all market maker. There are bankers on the other side of the end to trade with you. Okay. Second question that he has is, can you explain about the use of currency ETFs to hedge currency risk? So, as I said, the complex ETF, especially the synthetic one, a lot of these are synthetic, currency ETFs are synthetic. So the best is don't touch them. All right. I see a lot of people hedge the currency, right, and they do worse. Okay, they do a lot worse. And you have to understand, in your pocket right now, in your wallet right now, right, you have one of the strongest currency in the world. Why would you want to trade for something worse off? Okay, MES already give you a clue, right? They always have a currency band that they trade against the basket of currency that's not known to other people, right? But you can roughly know who are the bigger currency, right? Our major trading partners definitely have US dollar, euro, yen, as well as yuan. All right. So and then you can see it's upward sloping kind of a band, right? What does it tell you? It tells you that they are going to make Sing dollar strengthen against most of these currency. So which means if you want to hedge currency, right, against Sing dollar, I think it's not a very smart move because the odds is against you, and we have very strong reserve to defend that currency band. So which means it's very likely to happen. Okay, so I would not do any hedging on this case. Question from Simon: what is tracking error on ETF? Okay, good question. All right, so let me just go back to actually I don't need, I can just explain verbally. So we talk about the ETF is supposed to mimic exchange, an index, right? An index. Okay, so when you try to copy somebody else, right, because there's a difference in the timing, right, there can be some error in the copying. Am I right? So that is known as tracking error. So even though the index say that, okay, we are going to change this stock out of the index on this date, the ETF may not be able to complete the transaction, right, that they wanted on the same day. Okay, and the price that they get in and out, right, may not be the same price that they are looking for. So there can be some errors going forward, and that is the tracking error. So you want this tracking error, right, to be as minimal as possible. Okay, so you can actually know the tracking error. Let's go to SPDR, for example. Okay, you should be able to see the tracking error. Let me find the performance. Let's see whether they publicize the tracking error. Right, maybe I just do a search. Okay, so they did mention something about tracking error. I remember seeing it before. Alright, let me just try to find. It might be in their fact sheet or their product highlights. Okay. You can see, no, it's not here as well. Okay, there you can see rolling 1 year tracking error 0.0917%. So it's very minimal. It's not even 1%, or it's not even 0.1%. Alright, so that's how tracking error works. You want it to be as low as possible. Alright, so that's Simon's question. Janice asks, what do you think of commodities ETF or agriculture ETF? Okay, so if you ask me, commodities and agriculture ETFs are all derivatives. Okay, because the nature of commodities is there's no actual underlying, unless you really store the crude oil in your house or you store the orange juice in your house. Otherwise, there's no way that you can get exposure via the underlying. Okay, so it's usually done through futures, which are derivatives. And it depends. A lot of people have different views on commodities ETF because they are not recognized as a traditional financial asset. Because commodities do not give you dividends, it don't give you interest. Your wheat doesn't just grow after you harvest them, right? So they are negative yielding assets per se. So in the long run, it doesn't produce cash flow, and it actually erodes your holding. It actually increases your holding costs because you need to pay money to store them, right? And if you ask me, usually people do it via precious metals if they want to gain certain exposure to commodities, because gold seems to be a lot more better to perform uncorrelated with stock and bonds. Okay, the reason why you want commodities and agriculture, right, is that you want it to defend against a drop in, say, your stocks and your bonds. Okay, because they're not correlated, you hope that the commodities and agriculture can do well in your portfolio. So I think you can consider gold, which is a lot more storable compared to the other commodities, especially those with expiry. All right, and usually commodities ETFs are also more expensive in terms of the expense ratio. Felix also asked about liquidity. Minimum quantity. Okay, Felix asked about minimum quantity. Yes, it might be different for different ETF. That means the lot size. So you go to SGX website, you can see this bought lot. So 10 means 10 units per lot. This is 100 units per lot. So there is different number for different ETF. Right. Ming An was asking, why do people still want to trade synthetic ETF? Why? This is a good question because some people are more speculative in nature. Probably they just want to do short-term kind of thing. So they don't care whether the fund holds a real stuff or not. Winkin asks, is there an expiry date on ETF? Nope, there isn't. Okay, they are not time dated. Patsy was asking, is there the breakdown of the various charges on this SPDR website? Yes, they actually break down for you how much is the management fee, how much is the trustee fee, etc., etc. Okay, you just have to look deeper into it. Let me see what else. Josephine is asking, ETF supposed to track index closely, but there are times notice the last done price of ETF is like 8 to 12 cents higher than index. Yes, so these are things like tracking errors, etc., etc. Okay. Felix asks, any potential downsides of ETF? As I mentioned, those are risks, geographical institution risk. So you still need to manage your investment as a whole. So you cannot just buy one ETF for your whole portfolio. It actually isn't a very conservative way of approaching investments. So let me just answer one or two questions more, and then I think we are pretty much okay already. Okay. Joshua was saying, I previously used the 80-20 stocks bonds method to build my ETF portfolio. But after I read your book, I prefer to diversify into gold and cash. Would you recommend to build a portfolio slowly or rebalance by selling out my stock ETF? Okay, so you're thinking of switching to permanent portfolio, right? Okay, so yes, you should do one time instead of doing it slowly because you need the diversification right from the start. Okay, and I'll just take one more question. Any benefits if we invest ourselves manually consistently every month without going through money investment plan? Yes, you can. But actually, if you ask me, it is not advisable. You know why? Because you cannot trust humans. You cannot trust yourself. I also cannot trust myself because it requires discipline, right? Imagine this, right? You're supposed to put, say, $200 a month into buying STI-ETF, for example. And then this month, right, the STI dropped a lot. Okay? It dropped a lot. Okay? It dropped, let's say, 30%. Naturally, right, we'll be very scared. We say that, why not we wait 1 month later? It might drop even further. So you might not be able to have the discipline, right, to continually invest. And you may go for holiday for the whole month and then, I spent a lot of money already. Maybe I should not invest. So there can be a lot of excuses that we give ourselves. And you have to make it a priority. And it's always best to make it automatic and reduce that human error that we sometimes over trust ourselves too much. Okay, so that's all